Welcome to Straddle Income. We're here to help you make money in the stock market. Today is Tuesday, August 11th, and I want to talk about two things with you guys today. One, some of the trades that I made today, giving the overall market and rotation and the different aspects that you should be aware of. And then secondly, I want to talk about some of the stocks and model. So with that being said, let's first jump into the trade right off the bat. So today, there are a couple of things I did, and I wanted to talk about some of the trades that are kind of in the beginning phase for the option traders. Then I want to talk about one particular strategy where, if I think it would be a very good idea for some of you to be aware of. It's called a calendar spread, but it's really a more intermediate / advanced strategy. So I will go over that particular strategy in a later, much more detail. So let's first talk about the trade that I made today. Right in the morning, I was looking at the entire market, and the overall market is very interesting. A lot of the rotations last couple of days, Nasdaq has been really selling off. It's now actually pulling towards a very close to one of the moving average lines, the 18-day moving average line. As you can see, it actually dropped and then bounced back. So Nasdaq has been selling off. There's strong rotations, going away from technology software stocks and some high flyers to some more, the small and the medium cap of stocks. And this is expected because, the earnings for a lot of the technology company are done, and the earning ramp up as pretty much, they lost all the momentum. And now the next phase is a lot of the small and the medium-sized companies, the slow movers, they're going to report earnings. And of course, the hot money is going to move to that particular sectors. There's a lot of anticipation before the earnings. People are, very highly anticipate the reports from the small, medium companies who are going to report earnings. So this is expected, and the key takeaway here is, it's still very healthy. It's kind of just bounced back to the 18-day moving average. And we'll be monitoring those closely, but a lot of technology stock has been selling off. That's why I've decided to do a couple of the trades that I normally wouldn't do that. First of all, eBay, there's some rumor and news about eBay. So the eBay stock has been popping up. During the middle of the day, there was if we look at it today, it actually closed a little bit. But if we look at the 30 minutes, there was a couple of periods where eBay actually popped up, and there was a rumor and news about eBay. There's, what I did particularly for eBay is I bought October 16 calls. At the time, it was very cheap, around $16. So it has a couple 3 months out, and I'll just see if there's anything going to be happening in the next couple of days. Right now, the stock is trading at 54. This is $80. So really, we're talking about 2 standard deviation away. So it's very far away out of the money. So it's a very, kind of just small investment to ride the wave if anything happens. So that's eBay. Another stock I did was Qualcomm. Qualcomm actually has there was news about Qualcomm winning the lawsuit. So during the middle of the day, Qualcomm stock actually performed really well. There was a huge ramp up. That the fact that they have won the lawsuit, meaning that they don't need to pay the royalties and other stuff. But in the end, so that's where a lot of people are anticipating Qualcomm is going to have a run in the next couple of days. So that's what I did. Instead of buying the call, this time I did something different. The call price at the Qualcomm at the time was about, I think it's about $200. Right now you see it's kind of just dropped a little bit, but basically, if we were to buy the call directly, you would have to pay about the $182. And then, for some of you guys who have a budget in the mind when you have any investment, and I think this is a really good practice. You always should be thinking about how much you want to invest, and so that you can be, protective of your investment. So if you think this is too expensive, one of the similar trade that you can do in terms of buying a car is called a call spread. It's called a bull call spread. Basically, what it does, you're buying a car at a particular value, in this case 120, and then you're selling another car a couple dollars away from that point. So by selling the car, you're actually selling the car at the $58. So there's an offset of $1.82 minus $58. So instead of paying $182, you're actually paying $124. So that's the benefit of cost spread. You can lower your initial investment, and then you can also enjoy some of the call and the upside potential when the stock is running up. However, there's no free meals because you're having you're basically paying less. You're potentially is going to be rewarded less, and that's basically what the cost spread strategy is. So let's look at analyze this particular trade. So cost spread is let's make it a break even at the expiration date. So basically what it means is that if the stock, and this is, by the way, let me actually change it back to 110 and then 120. So this is a better representation of what's really happening here. So from this part onwards, you're basically essentially buying the car at 110. However, if you were just to buy the car without doing anything else, you will have unlimited potential of upward trajectories. But because of that, you have to pay a lot of money. So in this case, I'm selling the car at the 120. So basically selling the car at this price right here. I'm capping my potential, but in the meantime, my initial investment is cheaper. So this is a cost spread strategy that I want to share with you guys. The other thing that I did, I also bought 100 shares of a Gap. So I have been looking to the Gap for a while. I think now the fact that today actually broke, had some small breakout, really got me interested. So that's when I purchased some of the Gap stock and for 100 shares, trying to see if there's any opportunity I can sell any cover calls on top of it to get my initial investment back. But the cover call for Gaps, I think I was looking at a couple periods, for example, the August 28th, where it has the highest implied volatilities. It's not really very attractive. If I want to sell the cover call for Gaps, $15 right now, I want to do $18, which is still quite close. I can only make about $23, which I think it's not very enticing for me. So I would just probably stay close to the Gap coin and see how it goes. And last but not least, I want to talk about the strategy I did also. It's called the UAL. This is about a United Airlines. This goes back to my opening statement that the market is really have a rotation. A lot of the Dow Jones key components, they have been slower in terms of ramping up compared to the stock high-tech market. But, because of the rotation, they're getting some good exposure in the last couple of days. So I've been interested to buy the UAL, but one of the things, UAL, which is, has really been impacted a lot by the COVID. But the UAL, the last couple of days, has been really cramping up. There's a lot of exposure on the UAL. So I was looking into it, but however, I'm not quite sold that UAL is a very safe bet. So here's what I did. I did a strategy called a calendar spread. So basically what a calendar spread is, I'm selling the UAL at the $45. It's very far out of money. Today is $36, $37. Very far out of money at $45 by selling a call. As you know, by selling a call, basically I'm obligated to provide 100 shares of UAL should somebody decide to exercise, the contract after they acquire it from me. They have the right to purchase 100 shares. So I have the obligation to deliver. However, to reduce that risk, I'm also buying the UAL call at the $45. at the October expiration date. So basically, September expiration date, I'm selling the call at 45, and October 16, I'm buying the call at 45. This strategy is advanced in the sense that you really have to monitor it. This is really play into the fact that the implied volatilities and the time decay of the option contract natures. So as you know, this is getting a little bit technical. So as you know, the option pricing are determined by a couple different factors: implied volatilities, time, and intrinsic values, and vega, theta, all those kind of things. So I don't want to go through too much. The two key things is when you buy call puts and you want to sell calls and puts, the two biggest contributors in terms of the contract pricing are time and the implied volatilities. Really, the Canada spread is taking advantage of the implied volatilities and the fact that there's a time decay and implied volatility. The spread, the call that I'm selling at the $45 will decay faster than the call that I'm buying, which is further out of the money. So let me repeat it again. The call that I'm selling near term will decay, will become cheaper, faster than the call that I'm buying further away from compared to the first trade. So really, I'm trying to leverage the fact that there's time decay, there's implied volatility move between the two calls, and that's where I actually can leverage the profit, the difference between the two contracts. So let me explain that in the risk graph. So I have the UAL. So let's take a look at the risk graph. The UAL contract that I'm talking about here is basically this part right here. Let me actually zoom out a little bit. You can see. So the UAL contract is about selling the 55 at the September and buying the 45 at in October. So this is where the benefit of UAL. You get a benefit of Canada spread. You can really see there's very limited downside. It's about $130, where this is potentially maximum you can lose. But the upside is you can really enjoy the ride up if UAL actually goes above $38.58, and it will peak at $45. So if UAL goes above around this period, I can take a lot of profit during this period. However, my downside is only $130. Be very careful with this particular strategy, Canada spread. If you don't know what you're doing, you might be able to lose a lot of money here, because really you're playing the difference, the delta between the two contracts here. And there's a potential risk of being assigned if you're not very careful. For example, if hypothetically on September 15th, the UAL is at $45, because I'm selling the call, I have the risk of being assigned, and somebody can exercise the contract, I can be assigned. So I should be really monitor this very closely. And if I decided, my initial intention is not to selling the 100 shares of UAL, I should really close this particular thing really quickly, before the expiration date to avoid being assigned. So this is something tricky about the Canada spread, even though it has a small downside risk and have very high upside. The one additional factor you always should be careful is the risk of being assigned, the assignment risk. So be careful when you play this kind of Canada spread. And again, this is more advanced strategies. So that's what I want to talk to you guys about today. And tomorrow, one of the things that I think everybody is going to look at is definitely the Tesla. The fact that they have announced a stock split of 5-to-1 is going to make the stock more accessible to the general market. Right now, Tesla is trading about $13.74. But by making it more accessible to the market, a lot of people are going to buy it. And the key thing about the stock price is always determined by the supply and the demand. when people are going to buy it, the price will go high. That's why you're seeing that for the Tesla, if you look at the extended hour, they have really ramped up. The fact that the moment they announced the news, people are buying Tesla shares right away. And as you can see from this chart, and also from your memory about what happened to Apple the last couple of weeks, Apple stock has really been, driving tremendously upwards in the last couple of days because of the fact that people wanted to acquire the stock before, it splits. So I really anticipate Tesla is going to have a similar kind of momentum tomorrow. So I'll probably trying to see if there's any potential things I can do tomorrow morning to buy some calls, further away from them for the Tesla. But to be very careful here, Tesla, their stock split is around August 28th. So if you want to buy anything, call, try to do that before, the end of the August. So anything above August or the calls, I think it's going to be very interesting to look at it tomorrow. So with that being said, these are everything I want to talk about it. Just to recap, calendar spread and the bull call spread are more advanced strategies than just buying the call and the put. So trade it, with care and be very flexible. If you don't know what you're doing, you can potentially lose all the money by trading options. So with that being said, I hope you enjoy. Thank you so much for your time and attention. I'll see you the next time.